everybody, and welcome to today's Wealth Essentials session on account types. Now, this class is primarily going to be focused on US-based retirement accounts, and we're going to go through the different types of retirement accounts that are available specifically in US markets. Now, before we get into this, one thing that I must stress is that this is not a substitute for financial advice. If you feel like you need true financial advice, please consult with a licensed financial advisor and somebody who can take some of your personal situations and circumstances into account. What we're going to do in this class is simply give you an overview of the different account types that are available. Now, I know that many of you are do-it-yourself investors and people that may not consult a financial advisor, but understand that if you have specific questions, the best thing for you to do is to consult a licensed financial advisor to get the right answers for your situation and certainly know the risks involved with investing. All right, let's go ahead and get started. So as we think about retirement, retirement is going to look different for each and every one of us. For me, when I think about retirement, it's not getting in an RV and traveling across the country, although for many people, that's what they want to do. For me, retirement isn't working until I'm 71 and then staying home more often than not. Retirement is going to be different for everybody. And one of the things that I would highly recommend everybody to do is to start to envision what your perfect retirement would look like well before you get into retirement. Start to envision, what does a perfect retirement look like for me, so that you can plan ahead. Things like vision boards and things like goals and dreams and aspirations are not to be taken lightly, but you've got to understand the right path for you based upon the goals that you want to achieve. So when we're looking at where we are in our lives, no matter at what point we happen to be, one of the things that we are big believers in is that we all have multiple buckets of funds, right? And we're going to talk about two buckets. And the first bucket we're going to talk about is the income bucket. See, the income bucket is the money that we make to live on every day. This might be the job that we work on. It might be the businesses that we own. It can be a side hustle, right? And I know lots and lots of people that, they've got a good, steady paying job, and then they also do an additional work on the side. Maybe you work in an IT department of a strong company, but on the side you program websites for individuals, right? Whatever that happens to be. Rental income, if you've got rental income coming in. Dividend yield from high dividend paying stocks, or maybe you've got dividend coming in from bonds. That would also be considered income. Certainly trading would be something that we would talk about in income if you were more on the trading side. Or then there's also any sort of passive income that you may have coming in. Income that's coming in from some sort of referral-based business, or potentially maybe you've got some sort of a long-term income bucket that's gonna support you. Well, the other side is our wealth bucket. And our wealth bucket is really where we talk about our savings, our retirement accounts, our government-sponsored pension plans, or our company-sponsored pension plans. So when I say government-sponsored pension plans in the United States, we would call that Social Security, right? Or a company-sponsored pension plan. Now, this can also be real estate. Now, notice I have rental income and real estate, rental income on the income side, real estate on the wealth side, because this could be where maybe you take a look at some of the real estate that you have that has some appreciation attached to it. To me, that's where the appreciation would come in. And then maybe business investments, right? Maybe you're an angel investor in a small business and you consider that going to be part of your retirement plan, or any tax-sheltered accounts, right? Maybe you've got an IRA or a Roth IRA or something that is in a tax-sheltered style of an account. All of these are going to be, different for each individual investor. Everyone's going to have their own setup. What we focus on mostly at TradersArmy are going to be trading and on the income side. And then on the wealth bucket, we're going to talk about retirement accounts, because we're going to have different focuses depending on where we are in our lives. The thing to remember is that as we enter into different stages of our life, we have different priorities, right? In our 20s and maybe our early 30s, we're focused on growth, right? It's all about getting that first job and establishing where we are in our lives. And then it's really all about earning and saving from our 20s and 30s heck, all the way to our 70s for a lot of people. And then we spend the last 20 or 30 years retiring. The one thing that my mentor told me a long time ago, he said, you spend the first 30 of your life growing, the second third of your life earning, and the third third of your life retiring. And so I've got to be able in that earning and saving phase to be able to make a transition. And when we're in the growth and earnings phase, we are way more focused on our income bucket. Our income bucket is the big and more important thing, and the wealth bucket is significantly smaller. But over time, that's going to transition. And it's going to transition to the point where my income bucket is not as important to me as the wealth bucket. And the wealth bucket becomes bigger. Now, when I look at that transition, the thing that I say is it's the snake closest to you. You got to take care of the snake closest to you. And when you're in your 20s, your 30s, your 40s, it's about living the life day to day and getting through. And so we don't always focus as much on the wealth bucket. Now, we've already talked about the power of time and compound interest and why it's important to start saving and earning earlier rather than later. And so what we want to do is talk about, different account types that I might use as we transition over to that wealth bucket. So let's talk about those account types. The first is a very simple cash account. Now, when we look at a cash account, cash accounts are typically used to trade exclusively stocks and ETFs. Additionally, you'll find mutual funds, by the way, in cash accounts, but we're going to talk primarily towards stocks and ETFs. Now, the thing about a cash account is that your buying power is restricted to the amount of money that you deposit into the account. You cannot borrow money in a cash account. There is no leverage allowed in a cash account when it comes to the stocks because you're borrowing money. Now, that's not to say that you cannot use a leveraged asset class like options, but you're not allowed to borrow money in that cash account. Now, if you can't borrow money, that's the reason why you cannot short securities in a cash account. And without that ability to short, what it does is it makes most people one-directional traders and investors only looking to the upside. Now, this also causes more limitation of asset class choices. When you think about cash accounts, this is going to be very broker specific. A lot of brokers are going to limit the asset classes that you can trade in a cash account. Not only will they limit the asset classes, but they'll also limit the way you can trade inside of those classes. Like, for example, you may not be allowed to trade options in a cash account in all brokers. Some brokers will allow you to trade options in a cash account, but they're going to limit what it is you can do. Check with your local brokerage firm or investment firm to figure out what are the limitations that you have. Now, when we think about the retirement accounts in the US, the UK, and Canada, they are treated as cash accounts. So there's no shorting and no borrowing inside of those cash accounts. Now, the other side of cash accounts are margin accounts. Now, on a margin account, they're used to trade on margin, which creates leverage. Now, that leverage, understand that leverage, while it increases your rate of return, also increases your risk. And when we talk about the leverage that it creates, it's the ability to borrow funds, right? And that higher leverage, it can amplify both your profit and your loss. So when you utilize a leveraged asset class or you utilize borrowing funds in a margin account, your losses are amplified. You're essentially borrowing money from the brokerage firm. That's really what you're doing when you utilize margin. Your brokerage firm is acting as the bank, and you're paying interest on that money. And it's very, very important to understand how that interest is calculated. And typically that interest is calculated on a daily revolving rate, similar to a credit card would be when you're doing that. Now, typically your margin rates are going to be significantly lower than a credit card. But if you're in a long-term position that requires margin, you have to anticipate that margin expense coming from your profits in that position. And if you fail to anticipate the expense of margin, what you can do is not realize that your returns are not going to be as high as you would anticipate them to be. Now, in margin, you only pay that interest on money if it's carried overnight. There is typically no interest rate on intraday margin. So if you are more of a trader, then it's going to be a little bit better for you. Now, margin accounts are typically used in an income bucket. When we look at cash accounts, those are typically used in a wealth bucket. So when I'm focusing on these different accounts, I can have margin accounts or cash accounts, but when we're talking about the wealth bucket, we're going to focus on those primarily utilizing cash accounts. Now, in the wealth bucket, we've got different account types. So our different account types are an individual or joint account, right? Now, inside of that individual or joint account, you have to have some sort of a custodian typically set up. And that custodian is typically in the form of a brokerage or a bank or an insurance company or an escrow company. They're the custodians of that account. When we talk about especially U.S. based accounts, you have to have somebody that acts as the custodian, the trust holder, if you will, for these accounts. Now, because there are custodians and trust holders, that's why they can give you things that you're allowed and not allowed to do. Whether it is an individual or a joint account or a traditional IRA or a Roth IRA standing for individual retirement account, but whether it's traditional, Roth, simple, or SEP, and then there's other types of accounts, 401k, 403b, 457. Those are all a bit different. And then TSPs and RRSPs, specifically those the Canadian accounts in there as well. Those are all different retirement style accounts, and they all have pluses and minuses. Now, when I look at those accounts, they are the big thing that people traditionally like about the IRAs is that they are cash. They are qualified accounts, meaning that they have a favorable tax treatment in the form of the IRS. And so anything that is an IRA, an individual retirement account, has a favorable tax treatment in that we have some sort of a tax advantage. Now, the Roth is different than the traditional IRA, and we'll talk a little bit about what those differences are here in a few minutes. But we have to understand that a 401k can be a traditional IRA or it can be a Roth IRA. So 401ks, 403bs, 457, they can be either traditionals or Roth, but they are essentially just different types of IRAs. Now, what are the investments I can have? Well, almost anything you want is allowed in these accounts. It really is up to your broker as to what they will let you do or to not do. So if you want to trade individual stocks in these accounts, then you certainly have the availability for individual stocks. You certainly have the availability for bonds or even bond funds, mutual funds, ETFs, options, futures, precious metals. Real estate is even allowed in a retirement account. Annuities are a very, very popular vehicle inside of retirement accounts that certainly have their place. And each of these accounts have the ability in some way to be transferred or rolled. And when we think about an account that is transferred, these accounts that are transferred, meaning I can take the money from one brokerage firm to the other. They're very what's called portable, right? There's a lot of portability. Now, in IRAs, traditional, Roth, SEP, simple, any of those IRAs or RRSPs, you can typically transfer those from one brokerage to the other. Same thing with a 401k, 403b, 457, if you no longer work for the company, right? So you'll notice that 401k, 403b, 457, they show up under allowed to be transferred and not allowed to be transferred. Typically, if you still work for a company that is making some sort of a contribution, you are not allowed to transfer those assets out of that brokerage or that custodian into another. Now, if you leave that company, that organization, these are portable accounts. Portable meaning they stay, you can take them with you and then they can be transferred. So there's two things that you can do when you do that. One is called a pure rollover. The other is a transfer. So a rollover or a transfer is the process where funds from one retirement account custodian are rolled over or transferred to another custodian. It's moving from point A to point B. Now, they sound like they're the same, but they are very different, and there are definite differences. So let's talk first about a rollover. When you do a rollover, you actually take receipt of the assets or of those funds before reinvesting in a new retirement plan. So in a rollover, you're going to take receipt of those funds before. So your custodian will actually write a check to you in the amount that you want to roll over. Now, it's going to be very important that you have to find a new broker or a new custodian within 60 days of receipt of the distribution. Now, that that distribution penalty is in the U.S. typically about a 10% penalty if you do a premature distribution. So if you do a rollover, the money's going to come to you directly, and you then would send the money to another custodian. In a transfer, those assets are directly moved from one custodian to the other without you, the account holder, ever taking receipt of the funds. A transfer is a significantly cleaner way to do it, and it puts you at a lot less risk or exposure. So what you would want to do is when opening a new account, let's say that you have a 401k from a company you no longer work for, and you decide that you want to self-manage that account, and you decide to open an account at any one of the many different broker-dealers that would take your business, whether it is Charles Schwab, Morgan Stanley, TD Ameritrade, whoever it is. You go to that broker's website, you open up an account. It's going to ask you, how do you want to fund the account? If you fund the account via transfer, you're going to put in the account number, the value and all those pieces, and then it works brokerage to brokerage to facilitate the transfer. Right now, some brokers will call that a rollover, but technically it is still a transfer. Now, this can be done as many times as you like, and understand that you still ultimately are in control of your funds. Now, that's the difference in a rollover and a transfer. Well, what about my different account types? There are two types of accounts with who owns it. Right? There's an individual account or a joint account. Now, in an individual account, it's a standard brokerage account. There's only one owner. That owner can self-manage and control that diversified portfolio. These are typically eligible for margin on borrowing, options, futures, forex trading, all of those, but they will require the approval of that broker. Now, the interesting thing about an individual account is that upon the death of the account owner, all assets in the brokerage account are passed to the estate of the account owner, right? So they're passed to the estate of the account owner. That's different than a joint account. In a joint account, there's typically two or more account owners, and each owner has an undivided interest in the entire property. So it's not like 50% goes to person A and 50% goes to person B. It is a joint ownership, but there's an undivided interest. Now, once again, can still be used to self-manage. It's eligible for borrowing, trading options, futures, forex. But the biggest difference in a joint account is typically, upon the death of the owner, the remaining account holders, they retain the rights to the entire account. So upon the death of one account holder, the amount of the account and control of the account automatically shifts to the other member that's on that account. Now, that is whether it's an IRA, whether it is a cash account, a margin account. Now, in an IRA, it's going to be a bit different, however, because your IRA is typically going to be an individual IRA, and so there's going to be some definite changes there that's going to go to the estate, whereas in a joint account for a cash account or margin account, you can certainly have that joint account in place. But let's talk a little bit about IRAs. So our two types of IRAs are traditional IRAs and Roth IRAs. And now a traditional IRA, individual retirement account, it's an individual account set up with a financial institution like a bank or a mutual fund company and established to save money for retirement. Now, in a traditional IRA, the individual is setting aside savings up to a certain amount and the investments grow tax deferred, meaning that the account is funded with pre-tax dollars. So the dollars that go into a traditional IRA are pre-tax dollars. So there's no taxes paid on the money that goes into the account. Now that allows you to have more money to invest with, so that as the market continues to go up or as your investments would gain in value, you'd have a bigger base in order to build from. Now, in an IRA, you cannot take the money out until age 59 and a half. If you take the money out before age 59 and a half, anything that you take out is subject to an early distribution penalty. Typically, it's going to be 10%. You also have taxes to pay when you take the money out. So when the money comes out of a traditional IRA, it is taxed at the ordinary income rate of the person taking the distributions. So why do people do traditional IRAs? Well, the belief is that if I'm going to get taxed on it later in life, a lot of people say that later in life they'll be in a lower tax bracket and that it makes sense to pay the taxes later in life when I'm in a lower tax bracket rather than paying them now. Also, by using a traditional IRA, let's say that I put away $5,000 pre-tax. That's the full $5,000. Whereas in a Roth IRA, which we'll talk about the difference in a moment, Roth IRA is paid with post-tax dollars. So if you fund that Roth IRA with $5,000, actually you've probably made, I don't know, $6,500 or $7,000, but you only had $5,000 left after you'd paid the taxes. But both IRAs, whether it's a traditional or a Roth, they've got that 59.5. 59.5 is when you can start taking it, and you've got to start taking distributions at 70.5. So at 70.5, you have to start taking forth distributions from that traditional IRA because, well, the government wants to make sure that they get their money so that you pay the taxes on that account at some point. Now, traditional IRAs, you can have a 401k is typically traditionally a traditional IRA. And so that traditional IRA and say a 401k is oftentimes met with a company match, right? A company match inside of a traditional 401k or a 457. 457 works very much like a 401k in that your employer is matching you. It just comes from a different type of employer. Typically, a nonprofit organization is going to have a 457, whereas a for-profit company will have a 401k. Now, a Roth IRA, it has a lot of the same features of a traditional IRA, but the biggest difference is when the taxes are paid. So in a Roth IRA, you actually fund it with post-tax dollars, but all of the gain in a Roth IRA is tax-free. So in a traditional IRA, if you put in $100,000 and that traditional IRA grows to $500,000, when you take the funds out, you'll be paying taxes on the full $500,000. In a Roth IRA, if you start with $100,000 and it goes to $500,000, the $100,000 that you start with will already have been taxed. So when you grow to $500,000, you will pay no taxes on the distributions, right? So the difference between the traditional and the Roth is, do I pay my taxes now or do I pay my taxes later? And so you ask yourself a couple of key questions when deciding whether I have a traditional or a Roth. Question number one is, do I anticipate being in a lower tax bracket later in life? If you do, then a traditional might make more sense. I will tell you, my goal is not to make less. My goal is to make more or the same. So for me, that's kind of a moot point. The second question that you'd have to ask yourself is, how aggressive do I believe that I'm going to have gains? The more aggressive you have in your gains, the more a Roth makes sense. All right? The more aggressive your gains are over a longer period of time, the more a Roth is going to make sense. It still has the same rules. You can't take it out unless you're 59.5. You can make a payment into your Roth IRA after age 70.5, and you can leave amounts in your Roth IRA as long as you live without that forced distribution. So once again, you're really going to want to take a look at which one makes the most sense for me. Now, I know a lot of investors that have both. They have a traditional IRA with their 401k or their 457 or their employer-sponsored retirement plan as a traditional IRA. And then they set up an additional Roth IRA so that they kind of get the best of both worlds. But certainly, each individual's circumstances will determine which one makes the most sense. Now, what if you are, we talk about these 401ks if you work for somebody. What if you are self-employed? Well, a simplified employee pension plan, a SEP IRA, it's designed for self-employed individuals and small companies. Now, there's very few administration costs if you're self-employed and you don't have any employees. Now, if you do have employees, all the employees have to receive the same benefits under a SEP plan. So you can use a SEP plan if you have employees, but every employee must receive the same benefits inside of there in order to pass what's called non-discrimination testing. Now, those funds can be invested the same way as in any other IRA, and the same rules apply. It's taxed as ordinary income when qualified withdrawals are taken after age 59.5. So for the year 2020, employers can contribute up to 25% of an employee's compensation, or up to $63,000 if they're over 50, and $57,000 if they're under 50. So It's got a very high contribution number attached to it. Part of the reason why people like these is that you can contribute a lot more money into a SEP IRA. For a business owner, another opportunity is what's called a simple IRA. Now, the simple IRA is a savings incentive match plan for employees. This is typically going to be done with small business owners. It's an employer-run savings plan, and it features the tax-deferred contributions, very similar to that SEP IRA, but it's only eligible for employers with 100 or fewer employees, and they cannot maintain another retirement plan. Now, the advantages of the simple IRA for an employer is that it's much lower in administrative costs than a 401k or a 403b. The downside for an employer is that the employer can only match up to 3% of compensation, right? It can be reduced to 1% in any 2 of the 5 years, but you've got to do that 3%. And you certainly have a different spin on there because in a simple IRA, it's going to make that match a bit lower, but it's a forced match. Now, the compensation cap for determining employer contribution amounts is $245,000. If you've got people over 245, then you're going to want to move from the simple to the 401k. Funds cannot be removed from a simple IRA until it's been established for at least 2 years. All right, they're subject to federal income tax and/or a tax penalty, and the employer can match, and those contributions are tax deductible. So the simple IRA is a very good tool for smaller businesses or individuals that maybe start a company that want to be able to provide retirement support for their employees, but as they grow and get a bit bigger, the one that makes probably more sense is the 401k. Now, the 401k, you'll also hear me talk about the 403b or the 457b or the TSP for federal employees. The traditional 401k, it's a defined contribution plan where an employee can make contributions from their paycheck with either before or after tax. Now, if it's before tax, it's going to be a traditional IRA. If it's an after tax, it's going to be a Roth IRA. So you can have a Roth 401k if the contributions are made after tax. So the contributions go into a 401k account, and the employee then chooses the investment based on the options provided. The benefits of a 401k, a 403b, a 457 is that as an employee, I typically receive some sort of a match, which increases the amount of money that I can invest with. The other benefit is that they've got a significantly higher contribution amount. I can put more money into these employer-sponsored retirement programs. What's the downside? Well, the downside of these programs is that there's typically only a fixed small number of investment choices available. And if I want to trade anything other than what's available inside of that bucket that I have, then I typically don't really have many options to go there. Also, these are typically mutual fund investments, which means they're positioned only in an up market. They are long-only positions. So as an investor, I really have no opportunity to go short. So 401ks, the limitations are in the mutual funds and in the fact that you can only go long and there's no margin or no borrowing. And typically you can't do options in a 401k, but that depends on your individual employer and their plan with their broker. Ultimately, one of the things that I tell people is if you're going to get a company match, take it. I know lots of people that there's a lot of people that poo-poo mutual funds. I am not one of those people. I don't believe that a mutual fund is a bad investment product. I think there are other better investment products, but I do believe in utilizing mutual funds inside of a 401k or a 403b, provided that I get a match. If I get a match in my contribution, then I certainly want to participate in a 401k, even if mutual funds are my only choice. We will, in further classes, talk about how to manage a 401k. Right? And around those different choices. So here's really we'll call it the skinny. This is, I think, something that's important when we look at our contribution limits. How much money can I put in? And it really changes whether you're under 50 or over 50. Now, if you have a self-directed IRA or a self-directed Roth IRA, your contribution limit is $6,000 under the age of 50. Over the age of 50, it goes up to $7,000. So you have a much lower contribution limit. But take a look at the other IRAs that are available. Look at the SEP. The SEP IRA allows you to contribute up to $57,000. This is for most small business owners, probably the one that's going to allow you the highest amount of contributions, and it makes a lot of sense because I can now put $57,000 of tax deferred money away in order to save. That will oftentimes reduce your taxable liability for your personal income, and then just puts that money inside the wealth bucket. Simple IRA has a limit of $13,500 if you're under age 50, $16,500 if you're over age 50, and then the 401k, 403b, and 457, those both have a $19,500 limit if you are under age 50. Now, if you are over age 50, that 457b will allow you to go up to $39,000. And so it's got a little bit more than the $26,000 of the 401k and the 403b. So one of the things that I'm a big believer in is put away the money that you need for retirement. But we talked in our last class about more important than the money I put away is what kind of rate of return do I earn, right? So knowing what are my limits of contribution for each of these is important. But also how do I manage each one inside of those different buckets? But knowing what's available in the buckets is certainly going to be helpful. If you've got questions on this, once again, we will take your questions, support@tradersarmy.com. This is, once again, not meant to be financial advice. You certainly want to consult with your financial advisor on your individual situation if you have any specific questions. But if you got just questions around the information provided, please send us an email. We would love to hear from you. So we'll talk to you soon. Have a great day. See ya.